Ladies and gentlemen, good day and welcome to Apollo Hospitals Limited Q2FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, sir.
Thank you, Faizan. Good afternoon, everyone, and thank you for joining us on this call to discuss the financial results of Apollo Hospitals for the second quarter and the first half of FY22, which were announced yesterday. We have with us on the call today the senior management team represented by Mrs. Shobna Kamineni, Executive Vice Chair, Mrs. Sunita Reddy, Managing Director, Dr. Hari Prasad, President of the Hospitals Division, Mr. A. Krishnan, Group CFO, Mr. C. Chandrasekhar, CEO of AHLL, Mr. Obul Reddy, CFO of the Pharmacy Division, Mr. Sanjeev Gupta, CFO of Apollo 24/7. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. Please note the disclaimer mentioning these risks and uncertainties on slide 2 of the investor presentation shared with all of you earlier. Documents relating to our financial performance have been circulated earlier, and these have also been posted on our corporate website. I would now like to turn the call over to Mrs. Sunita Reddy for her opening remarks. Thank you, and over to you, ma'am.
Thank you, Mayank. Good afternoon, everyone. Thank you for taking time to join us on a Saturday afternoon. I trust all of you have received our earnings document, which we shared yesterday. The second quarter of FY22 witnessed a strong revival of the non-COVID business, with elective surgeries, out-of-station patient volumes picking up. We have continued to gain local market share, aided by a healthy uptick in local patients. There was also high growth in the insurance patient segment, especially from corporate. During the quarter, there was a renewed focus on the centers of excellence within our institutions, with high-end specialties like oncology, advanced cardiac sciences, robotics, neurosciences, and critical care accounting for a large portion of inpatient volumes. At the same time, we continue to keep beds allocated for COVID patients, and the strong iron curtain between COVID and non-COVID continues to be in place. However, the percentage of COVID patients treated in Q2 was much lower than in Q1. This combination of factors has improved our revenue intensity and our ARPOB significantly and enhanced the margin profile across both mature and new hospitals. In Q2 FY22, the inpatient volumes grew by 46% over Q2 FY21. However, volumes were still 6% lower than the corresponding period in FY20, mainly because of a lag in domestic travel, international patients, which we believe is a silver lining that will reveal itself in Q3 and Q4 as fears of the third wave recede. Vaccination volumes came in at a higher pace in Q2. Our centers, including AHLL, conducted inoculations for 2.9 million persons. As a result, our Q2 FY22 revenues include vaccination revenues of 246 crores. Overall, 5.3 million inoculations were undertaken in H1 of FY22. In Q2 FY22, revenue from COVID patients stood at 140 crores compared to the 491 crores in Q1 FY22. The total discharges for Q2 FY22 was at 120,105. Discharge of COVID patients was only 5,072 as against 23,456 in Q1 FY22. Against this backdrop, let me walk you through the financials for the quarter. On a year-on-year basis, our standalone healthcare services revenue grew by 56%. Combined pharmacy revenue was 1,530 crores, a growth of 4% year-on-year, normalized for COVID sales spurt in pharmacy revenue in Q2 last year. The year-on-year growth was 11%. This growth has to be viewed against the lens that during Q1 this year, there was a concentrated purchase of pharmacy items due to COVID, leading to overstocking of medical supplies in individual households, resulting in muted purchasing in Q2. Given the swings in pharmacy buying and behavior during COVID, the revenue growth patterns of the last 6 quarters have been rather inconsistent. We believe that this performance in this vertical will normalize in Q3, and we are committed to a growth of close to 20% overall in the offline business. This is already evident from the number of daily footfalls, which has moved from 400,000 footfalls to 527,000 footfalls per day. Overall, the company recorded a year-on-year growth of 17% in standalone revenues at 2,823 crores. Our new hospitals recorded revenue growth of 68%, while mature hospitals revenue grew by 49% year-on-year. Margins in mature hospitals were strong at 26.2%, and I am happy to state that our margins in new hospital continue to witness improvement, moving up to 17.5% for the quarter, registering a 653 basis points improvement on a year-on-year basis. Standalone AS 116 EBITDA was at rupees 439 crore, registering a year-on-year growth of 76.8%. Healthcare services EBITDA was at 392 crores, a year-on-year growth of 196%. Pharmacy distribution EBITDA post India's 116 stood at 95 crores with an EBITDA margin of 8.1 crores. This excludes the 24/7 cost of 48 crores. Standalone PAT was at 186 crores as compared to 33 crores in Q2 FY21. Net debt as of 30th September 2021 was at 1,297 crores with a debt equity ratio of 0.43. Consolidated results. Our consolidated revenue stood at 3,717 crores against 2,761 crores in Q2 FY21. On a year-on-year basis, healthcare services revenue grew by 75% to 2,169 crores. Mature healthcare services grew by 70% to 1,157 crores, while new hospitals grew by 84% to 664 crores. Group occupancy was at 65%. Despite the uncertainty caused by COVID, our retail Apollo Health and Lifestyle Limited has recorded an impressive growth of 122%. Q2 FY22 was driven by a rapid ramp-up in diagnostics as well as primary care business and a rebound on the secondary care formats, which are inching closer to the pre-pandemic levels. Diagnostics witnessed a significant growth in Q2, registering a 52% year-on-year increase to rupees 93 crores, including 56% year-on-year growth in non-COVID business, driven by network expansion and new and existing geographies, as well as continued growth in capacity to serve the rising demand for home collections. The consolidated post-India's 116 EBITDA for Q2 FY22 was at 615 crores compared to 300 crores in Q2 FY21. Within this, healthcare services EBITDA was at 506 crores compared to 163 crores in Q2 FY21. AHLL recorded an EBITDA post-India's 116 of 62 crores as compared to 21 crores in FY21. Consolidated PAT is at 248 crores as against 60 crores in Q2 FY21. AHLL is PAT positive in H1 FY22, a key milestone in its journey. Apollo 24/7 continued to improve on its consumer acquisition trajectory with over 12 million registrations and an increase in the number of PIN codes to over 19,000. Our subsidiary Assam Hospitals Limited has entered into a definitive agreement to acquire 64% majority stake in the 200-bed Excel Care Hospital in Guwahati. The acquisition demonstrates our focus on the Northeast and strengthens Apollo's leadership position in the city and in the eastern region, with a combined capacity in the Northeast exceeding 400 beds, including the existing hospital. Looking ahead, we believe that these results give us an insight into the strong baseline that we've established post-COVID and the potential that lies ahead. Our occupancy and volumes are at healthy levels and margins have continued to expand. There is still significant headroom for growth in volumes and occupancy in both mature and new hospitals as surgical cases continue to grow and international patients come back. The revenue growth and EBITDA expansion will only pick up in pace. Our pharmacy distribution vertical also has the canvas to deliver strong rates of growth along with the higher online penetration of Apollo 24/7. AHLL has hit its stride and will continue its trajectory of accelerated growth in both diagnostics and primary care. As the COVID challenge recedes into the background, the outlook for the medium and long term is positive, as all our verticals are primed for even better performance and will live up to their full potential. I have Shobna Reddy, Dr. Hari Prasad, our CFO Krishnan, Obul Reddy, Chandra, and Sanjeev from 24/7 with me to take to all your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, thank you. Good afternoon to all. First question is on the hospital segment. If I look at this segment, let's say if I just consider fiscal 24 and I'm combining the mature, new and proton all together into one bucket, after this strong quarter, do you see that if I were to talk about EBITDA in fiscal 24, just as a number, 2100 crore, 2200 crore, does that look as an aspirational number to you, or that looks as a very easy target, what we already done 500 crore plus in this quarter?
See, Anubhav, obviously we wouldn't want to give any forward-looking statements as always, right? So we continue to stick to the perspective of how we have performed in the quarter. So if you look at the quarter, clearly the 500 crores is something that we have delivered, and there is clear headroom for growth in our existing businesses, as you can see, because the occupancy still in the mature is 67%. The new hospital still has abilities to grow. You know, the point that you should remember is we have invested in significant capacities in the last 5 years, and you know that there is a potential for us to fire, and this is why the results are looking good. If we continue to look forward, we are quite comfortable to deliver margins even above this percentage that we have already delivered now. There is some benefit of vaccine which is still there in this Q2 also. You know, at the hospital level it is almost around 100 crores, but at the EBITDA level it is almost around 15 to 20 crores. So that's the benefit of vaccines that is there in the business. But then OPs have still not come back, medical tourism has still not come back. So we would like to believe that we should be able to perform on these numbers because there is headroom, and we have been continuously investing for that growth as well.
So just the clarity on that response is, as Sunita ma'am mentioned that there seems to be some benefit of bunching up of some high-end surgeries in this quarter, and that was reflecting in a very strong ARPOB across the clusters also. So does this quarter ARPOB seems reasonable, or once you normalize? That's why I was just fiscal 24. I was just taking as a little bit idea, but the question was largely that once things normalize, like the patients, international patients come back, etc. Surgeries are not as strong as what, let's say, the mix is not as favorable as was in this quarter. Is this 500 crore plus performance still doable?
Yes, of course. I think it's very sustainable. And the way that you should look at it is that if you replace the 5% that is COVID and low ARPOB and bring in the 10% international patients which pay a premium, I think this ARPOB is more than sustainable.
Okay, that's helpful. Second question is on 24/7. So we're doing the roughly annualized loss of EBITDA loss of about 200 crore on this. Just the question there, what could be a peak loss from 24/7, let's say, and when do we aspire to achieve EBITDA break-even in this segment? So this 200 crore, can it go to like 400, 500 crore annual loss, or what could be the peak number, and when will be EBITDA break-even?
I think Shobana will take that.
So it's actually not a direct question, because one of the things we have to understand is that this company has been taken out into a subsidiary. So and what we do believe that as more digital companies, as they hit the velocity, for us to break even would be in 2 to 3 years for sure. And what we believe is that if we're doing 40 to 50 million customers, so that is almost 200 times what we're doing now. At that point of time, we would think that we should be able to fund not the same proportion of losses, but as we get further down the journey, we'll be more efficient. So I think our IM feels that at peak we should be at a loss of. Sanjeev, would you have that figure on the thing? But again, it's based on a fundraise that we're currently in. So,
and I think, yeah, ma'am. And in case I add one more point, I think what is important to see today is that are we positive on the unit economics? So with the current set of numbers that we are doing it from 247, we are contribution positive, and some of the high-end geographies where we have large volumes are doing pretty good, and they're also contributing towards the fixed expenses. So as ma'am rightfully said, it's a matter of, I think the journey to the break-even for the company would be 2 to 3 years from now. And as far as the further funding is concerned, I think it's a little forward-looking statement, but I think the assurance is that, given our unit economics are positive, I think we are doing pretty good as far as this set of segment is concerned.
Sure. Just one last question on the pharmacy segment. So we've been adding for many years about 350 to 400 stores each year. So just wanted to get an idea, what is the constraint in adding, let's say, 700 to 800 stores? Because this will only aid us in, let's say, faster penetration of online segment as well, because we can deliver medicines faster to more number of people.
So Obul is here.
No, but actually, Obul, if I can take that question. Our logic really is that we'll continue to add 400 stores, especially in newer geographies. But what we're understanding is that we're also able to do a lot of serviceability with dark stores, which so we will have a combination of both of those. So I think as we keep increasing the pin codes we serve via omni-channel, both these strategies will go into play. But definitely we don't envisage being less than 400 stores a year.
But can you talk about how many million square feet or what square feet you have on the dark stores today, or that's a strategy for the future?
That's clarity for the future. Right now, what we're doing is that we're using our bigger stores to serve a certain pin code. So what just with our stocking, and we're just becoming more efficient on that. So the dark stores will probably be in geographies that we're just getting into, or which are very much online led. But if you see places like Telangana and Andhra and Karnataka, NCR, where we have deep penetration, Calcutta, there are less dark stores that are required. maybe Mumbai, because of real estate, will have to do a combination, a hybrid.
Sure. Thank you. I'll rejoin the queue.
Thank you. The next question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets. Please go ahead.
Hi, good afternoon. Thank you for the opportunity. My first question is on your operating costs. So we have seen increase in staff and other operating costs, largely in line with the normalcy in business. But on the gross margin part, we have seen a very strong 400 basis point sequential improvement. So can you explain what has led to this and how sustainable is this, the 2Q gross margin numbers?
Yeah, the gross margin has improved significantly, mainly because of the decrease in food volumes, because at the contribution level, material costs were rather high in earlier quarters due to the extended material use due to COVID. Now that has come down and our guaranteed fees based doctors are also functioning better in terms of volumes, our gross contribution has gone up. We believe this is sustainable because we believe our mix will continue to be going forward what it was in this quarter rather than what it was in an earlier quarter. So we see these contribution margins as going forward sustainable unless something changes on the COVID front. So you can take that as steady state.
Okay, ma'am. My second question is, can you update on some of the key metrics on 24/7, the way we have heard in the previous quarter, say in terms of number of deliveries which you are doing per day or number of consultations which you are doing, and the 200 to 250 million revenue target for 24/7. I hope like you are broadly on track to achieve that for this fiscal.
Sanjeev.
Yeah, I think some of the broad numbers that I can talk about is that today 247 has got 12 million registrations. We've got 19,000 PIN codes that we are servicing. We've got 6,000 doctors, for 138 specialties, and the promise to the user or the customer is 15 minutes. You consult with any doctor. We have a very good traction in the platform today. We have about closer to 2 million plus weekly active users, and our organic traffic share is also increasing, week by week. As far as the delivery side is concerned, I think at an omni-channel level, we are doing about 45,000 deliveries a day. This is for the pharmacy side, and apart from the VC and the diagnostic, we are closer to about 5,000-6,000 deliveries a day. The completion of the orders per day.
You mean to say 5,000 to 6,000 video consultation or teleconsultation you are doing right now?
Correct.
Okay. And in terms of revenues, around the number which earlier indicated, around 200 to 250, that looks video.
Yeah, that looks promising. I think we are meeting those targets.
Okay, and my final question is on diagnostic. Ma'am spoke like we have seen very strong traction there, but if you look at the margins, this quarter I guess they came at around 13%. Previous quarter, one quarter definitely had benefit of COVID and all, but how should we look at margins for diagnostic business, which has been volatile for last I'll say couple of quarters? Chandrasekhar?
Yes, ma'am. The quarter one FY22 had a significant component of COVID. The important point that we need to note here is that our non-COVID from quarter one to quarter two grew by 22%. So our core business sustainable is continuously growing, and we are also investing. So we've added our home collection capability by adding roughly around 500 phlebos, which are now trying to saturate PIN codes of interest and work along with 24/7 to be able to do that. That adds to fixed costs. So overall, our current EBITDA margins are in the region of 11%. but that is a conscious decision to have incurred additional fixed costs. We also have added a few labs in some of the new markets, which are yet to start delivering the required results. But I think a move to 15% over the next couple of quarters is very much in line, and we are in control with that to begin with.
Just to give you some figures, diagnostics delivered revenues of 51 crores, EBITDA of 11 crores.
91 crores, ma'am.
91 crores.
Sure, ma'am. Yes.
Okay,
sure. Thank you. Thank you for your response. I'll get back in the queue. All the best.
Thank you. The next question is from the line of Prakash from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on good numbers. Again, everybody is asked on ARPOB only, and my question also is around that. So I understand the case mix and all have improved. There could be some pent up also. But this international one, if you could throw some light, where are we today versus the 10% historical peak of international patients? And what are the other levers for margins? Like, this quarter is obviously all-time high across new as well as matured hospitals. Do we see this as sustainable base? Do we expect over next 3-4 quarters more improvement? What is the outlook here, please? Thank you.
Yes, if you look at ARPOB HCS, we're at 47,361 versus 38,000 last year. And we really do believe that this is sustainable. I think the icing on this would definitely be the fact that if international patient travel resumes in the third and fourth quarter, you will see ARPOB going up. The reasons for the high ARPOB are clearly our focus on centers of excellence, and this is really yielding the high ARPOBs, and you could see this especially in our Tier 1 towns and our mature hospitals, which are at an ARPOB in excess of 60,000. So the blended ARPOB is 47,000, and as continues to mature with international patients, and as new hospitals continue to pick up traction with surgical intensity increasing, we do believe that this is more than sustainable.
And what's our international patient mix currently?
Hari, you want to take this?
Yeah, currently it's about 5% of what we normally get because we're getting small batches of patients from a few countries. But what we see is it's increasing by month on month, and the trend looks good. And it is not just the international patients. I think it's even the local travel which makes a big difference because many of our large facilities get a large number of patients, of outstation patients from other states in the country. And we're seeing that travel also improving. And most of these patients who travel distances, whether international or from outstation, they come in for more complex procedures or more high-end procedures, where ARPOBs and margins are definitely going to be higher.
Yeah, okay, I understand that. And you don't see this as bunching up, like, for last 3 months, 6 months, post-wave 1, there would have been some bunching up. You are not expecting this to be a bunched up kind of case mix with the opening of travel?
We are actually expecting this to improve with the opening of the travel.
Okay, got it. And also, if you could help us with the payer mix versus currently what you are observing in Q2 versus maybe last year, the payer mix in terms of cash patients, insurance, and the government schemes.
Yeah.
Yeah. So as of now, the cash mix is much better. So clearly, if you look at the mix, if you look at the overall volumes that we had this year, we did almost around 50% came from cash. But typically, we have been looking at it. So insurance has clearly gone up. If you look at the insurance patients for the quarter, insurance has gone up, and the CGHS patients, etc., have been similar to what we had earlier. So if you look at the payer mix, it's not significantly, tilted towards walk-ins and insurance. The IPS or the medical tourism will actually add because we had only around 1,400 or 1,000 patients in this quarter, as opposed to almost 8,000-9,000 that we had in FY20, etc., in the same quarter. So clearly there is a fillip which can come from medical tourism, as we said. So broadly, I think insurance has seen some increase, but walk-ins, etc., are broadly similar, not significant increase that I would say.
So what I understood was cash is largely similar, insurance share has gone up, then what has gone down, sir?
That is, public sector has gone down a bit, and medical tourism has gone down.
Okay, fair enough. And lastly, on the 24/7 fund-based plan that we had, if there could be more color there, sir, in terms of timelines or any thoughts around, strategic partners, what kind of partners and timelines, please?
I think they're almost at the last stage. I think you will have to give us some time to come back on that.
But is this calendar year or is it moving to next calendar?
Definitely in this calendar year. We hope that in the next month or so to announce 2 significant partnerships and some significant strategic.
Okay, lovely. Great. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thank you so much and good afternoon, everyone. On this 24/7 platform, what is the immediate priority in 6 to 9 months to build this up? Is it building your technology backbone? Is it your fulfillment or is it customer acquisition? So if you can just talk about that.
Yeah. So, I think that what we've actually proven during this difficult time during the pandemic is that we've been able to open PIN code after PIN code, and we're the fastest delivery, 2-hour delivery. So we've done this across states and across PIN codes, something like 16,000 PIN codes. So and we've also seen that in terms of availability, we've improved our availability to and we want to push it to 95%, which will be the industry highest, almost comparable to Amazon in terms of availability. So these are some of the things that with the natural strength of the pharmacies we're able to do well. In terms of doctor consults, I think our technology platform is one of the strongest. While we keep improving on it, the ability to get an Apollo doctor in 15 minutes has proven to be an outstanding success, and we'll continue to grow on that. The diagnostics, we thought we would start it later. Fortunately, the diagnostics team was very eager, and they included almost 400 phlebotomists. So we were able to actually come in very fast into that area, and we continue to grow that more than our business plan for diagnostics. So these are our 3 actual service delivery platforms. But behind it, I think we have a suite of products which is in condition management, which is in the ability to better manage patient records, to be able to do the CDS, the clinical decision support system, for instance, has been benchmarked by MIT, and what they feel is that that it has one of the best accuracies in the world, and it's currently in the testing phase. So we've got almost 1,000 disease patterns mapped into this. Again, this is an Apollo advantage that we've been able to get ahead of everybody else. So on one side, technology continues to advance. Our service delivery has proven that it can deliver on capabilities. The next thing that we'll be pushing is really, now that we know and we have a level of confidence, we will concentrate on scale.
Yeah, that's great. Do you benchmark yourself versus the 3 leading health tech platforms? And I say that because they've been raising hundreds of millions of dollars, and the kind of spend that they will be doing and are already doing, versus we are spending 40-50 crores a quarter. So, at the end of maybe 1 year, 2 years from now, we may actually be left behind a lot.
No, it's a fantastic question. Thank you for that. First, you must understand that all that money is being used to fund discounts. We're taking investor money to fund discounts. And I think that is a race to the bottom that we should not be part of, because we are a long-term player and we value shareholder value. We can't install shareholder value on the other side. Having said that, I think that many of them are looking, some of them are trying to move omni, which means that they're trying to catch up to our 2 billion value of pharmacy investment. So, and if you really look at it, like Sunita had spoken about the numbers, 527,000 people walk into Apollo every day. Those numbers, it would take years for anyone to replicate, while we continue to grow strongly and we move digital. So I don't think there's a fear of competition, but I think there's the responsibility of doing the right things. And we see that even in the pin codes that we continue to be in, our customers continue to come back to us. Many of them are not swayed. During the pandemic, we had 42 lakh new customers contact with us, and we've been able to retain over 27 lakh of them that we've reached out to again. So I think our customer acquisition also has been quite effective, and we'll continue to invest into this.
Okay, great. And Sunita, my next question is on the hospital side. It's been a fantastic last 2-3 years. Great job done. But as we look forward, now from 2,000 crore sort of annualized EBITDA that you're generating, what's the pathway to double this to 4,000 crore, say, over whatever reasonable time period, 4-5 years? I mean, do you not need to add 2,000, 3,000, 4,000 new beds, or maybe more? So, I heard your commentary. It's fine. You will squeeze out some more efficiencies. But for the big picture, how are you thinking about it?
So, Sameer, that's a good question. And I don't know how much of this will be forward-looking, but as you can see, we're very focused on asset utilization. Our current occupancy is in the region of 65%, and with ALOS going down, there is a lot of headroom in the existing company. So that is the first bucket of it, is the headroom in the existing company to deliver an additional 20%, at least minimum increase in EBITDA. The second part of it is to look at how we are growing our clusters. And if you look at the cluster growth, I think, we've completed the Calcutta, we've bought out the Gleneagles stake. We've strengthened our presence in the Northeast corridor. And therefore, effectively, we're looking at the East as a cluster that we hope to dominate. And with this, I think, definitely you will see healthy ARPOBs. You will see growth in revenue, occupancy, which really flows to the bottom line. In Bangalore, we are looking at brownfield expansion, and from our current 500 beds, we should look at 800 beds in the next, in the next 2 years, we should be looking at 800 beds. So it's a combination of acquisitions. It's a combination of brownfield, organic growth, and some brownfield that we're looking at to really increase the number of beds and strengthen our clusters. So it's not just random growth, Of course, we are looking to create something in the north where we're looking at an acquisition. We are looking at Bombay. And we're sad we're not present in the city where all of you are present, but we are looking at a revenue share model, and hopefully in the next 3 years you will see a 400-bedded hospital coming up in central Mumbai, supported by our hospital in New Bombay And also, unlike all the other corporate entities, when we talk about clusters, we must remember that we have the daycare centers, which are part of it. For example, in Bangalore, we have 3 large hospitals, one in Mysore, but we have 2 daycare centers, we have 2 birthing centers, and we have about 20 clinics. So in terms of creating a cluster for delivering healthcare, I think, we're in a superior position. If you layer this with the connectivity that 24/7 is going to give us and the funnel it's going to create, I think you can definitely look at a significant improvement in our POB, and hopefully we'll be able to show this to you over the next 12 to 24 months.
Okay, great. This is very clear. Thank you so much.
Thank you. The next question is from the line of Shantanu Basu from Hospitals Limited. Please go ahead.
Most of my questions have been answered, so thanks very much. Just one clarification on the international revenue mix. I just want to know what is the percentage as of now that is being contributed to hospital revenue by international patients?
So as of now, it is very, very less. It is less than as a percentage of revenue, it is less than 1%.
Okay, fine. And what's your outlook for international patients going forward? I mean, in the next 2 quarters?
So normalized is 10%. So we believe that by the end of the year, by the end of the financial year, we should get to 10%.
So
for the last 2 quarters, you can look at the last quarter with 10% of the revenue coming from international patients.
Okay. And in Q3?
Q3 it's just starting to open up. So maybe 4 to 5%.
So you are seeing traction in international patients?
Yes, definitely. Lots of inquiries coming, and travel has started to open up, but the number of flights is still not normalized.
So how is this happening then? Is the number of flights still not normalized?
No, there is a plan. I think everything is in place that by March everything should be. The last quarter we should have January, February, March. It should be fully back. That's why we're projecting 5% for this quarter and 10%, moving on to 10% in the last quarter of the quarter revenue. Yes.
Right. Okay. Thank you, madam.
Thank you. The next question is from the line of Kunal Randeria from Edelweiss. Please go ahead.
Good afternoon, everyone. Ma'am, if you were to compare the surgical and high-end procedures versus 20, how would they look now for the quarter? Are they 80%, 85% of what we were in FY20?
No, we're higher than 80% of FY. We're about, let me say we're about 6% lower than FY20.
Okay. And in the 1.5 months of this current quarter, we are trending at the same rate, or are we at FY20 levels now?
Of this quarter, I think it's, except for the holidays, very difficult to, the dull period during Diwali. But again, it's picking up, and I think we should be back to FY20 levels in quarter 3.
Sure, that's helpful. And the second question is, as far as occupancy is concerned, we are pretty much around. So just wondering how we should see the trajectory going forward.
No, I think, when I mentioned this figure of admissions where we were at 122,000 admissions compared to 52,000 last year. So clearly, occupancy is a derivative also of ALOS. So if you were to look at ALOS and look at occupancy, I think admissions is a figure that we need to track. And this is where we are, where we believe there's an opportunity to grow, and it is tracking well for quarter 3.
Sure. Sure. And just last one, if I can squeeze in. Can you share what the hospital-based pharmacy revenues would be?
Which PP revenue?
Roughly around 18%.
18% of hospital services.
Yes.
Okay, got it. Thank you.
Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Yeah, thanks for taking my question. My questions are around the online pharmacy. We can see that you started offering discounts recently online in the range of 15 to 30%. Here, just wanted to know what is the company strategy. Are you matching what the market is offering, or would you plan to go higher in order to accelerate your customer acquisition?
So if you look at it, we're actually very nuanced. We're not giving any blanket discounts because one of the things is that we have to make sure the customer experience is truly omni. So I can't do things differently to a large extent. Some I can do. And for that, we have a Circle membership that is growing in popularity. So we've seen that the advantage of the Circle membership is that we've been able to get the actual ARPU per customer is much higher than a regular customer every time they transact. So they become valuable. Also, the stickiness is far greater once they've transacted with us about 3 times. So those are the customers as we move forward that we'd like to be able to find the ability to pass on discount advantage either directly from the manufacturer cashback or through our private labels. So I think that we'll have a very we'll have to do this strategy as we go on. For some products, maybe price matching, but mostly I think it will be towards acquiring long-term customers and rewarding them for staying loyal.
All right. And in terms of your total revenue share, how much of it is coming from loyalty circle members versus non-loyalty presently? Online as well as offline?
Yeah, online it's about 40 now. No, Sanjeev, just correct me.
Ma'am, it has moved up to 50% now. We have got total 1.2 million Circle members, and they contribute about 50% of the GMV.
Obul, how about from the offline?
It's about same, 48 to 52% it is ranging.
So I think these are the people that are, that we clearly understand what are their preferences, where they stay, and this kind of, how we can build that loyalty and continue to grow those numbers.
Understood. And just the last question on discounting, ma'am. So the only discounting you'll offer is to your loyalty circle. There is no blanket discounting like invoice-based discounting, etc.
Yeah, there is. You'll see, I can't say, like even in the pharmacy, if people make a significant purchase, they do get a discount. But, the discount is less. It doesn't go more than 15%, unlike the competitors that do 20-25%.
Okay. Got it.
And I think that really what the customers are looking for is that for repeat purchases, they're looking for values. But when they need medicines quite urgently within 2 hours, medicines that are not really easily available, they come to Apollo Pharmacy, and there's a significant market share that we enjoy in that.
Okay. And just a follow-up on that. So discount as a percentage of your GMV, do you track that metric, and how much would that be?
It has gone up. It currently, as it continues to grow up, what is it? Obul, blended discount is about 14%, 15, around that amount.
Around 12% blended today, ma'am.
12% online, offline blended.
11.8% to be precise in Q2.
Perfect. Thank you. Thanks, ma'am.
Such a tough battle, let me tell you.
Ms. Mr. Sharma, is that answer your question?
Yeah, I'm good with that. Yes.
Thank you. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah, good afternoon, and thank you for taking my question. Just the first one to Sanjeev. I think you talked about unit economics, 7. If you can help us understand, like, what is the average ticket size, anything, understand that business better. Million users, active users per week. Does it translate to 24 million per month? Per quarter. The run rate that you talked about, 200 million. So if you can help us understand how to disaggregate that, please.
Yeah, I think you talked about the average ticket value. So we have about 1,000 plus as average ticket value for the pharmacy line of business for the customers who are the circle member customers. And when it comes to the virtual consultations and the diagnostics, obviously we are looking at upwards of 1,500 average ticket value. And as far as the unit economics is concerned, I think given the fact that we have omni-channel play, our hyper-local delivery cost is pretty less. And you can appreciate the fact that we've got 4,000 plus stores pan-India, and pretty much, our logistic cost is much, much lesser than the competition out there. And that helps us to, bring us, faster towards the unit economics. So this is one point I would like to talk about. And the second thing is that as far as, weekly active users, I talked about 2.3 million weekly active users. And on any current day, we see about 4 to 5 lakh active users on the platform. And much of this is coming through the organic. And even our cost of acquisition is also pretty low. I think this gives kind of, answer to your question, or anything specific that you would like me to talk about.
Yeah, Sanjeev, when we mean how do they, so they just download the app, and can you explain what is organic?
So organic means is that, basically customers are coming off their own to our platform, and, they could be figuring it out, say suppose a specific medicine, which is not available elsewhere. So those customers, they come to your platform and they start figuring it out that particular molecule or a medicine is available, and then they start, searching that, they start giving you the order. And those are the customers wherein you would not have spent any money, right? Because organically they have come to you by searching certain medicines. And it happened, during wave 2 also, Q1 of FY22. And this is a continuous thing. Ma'am also talked about that, we are looking at about 95% of availability in our platform, which would be the best in the country, very close to, she talked about Amazon out there. So essentially people are searching out various things, and when they are not able to figure it out somewhere else, this is one funnel that comes to us organically. This is what we mean by organic customers to us, where there's no extra cost from our side.
Yeah, and lastly,
No, I'd just like to add one point to that. I think you have to consider the Apollo brand and the pull that the brand has. So I think in a healthcare space, whether it's a teleconsult or selling medicines, and the fact that Apollo Pharmacy has been doing this for 25 years, it's a very strong brand that draws customers.
Sure, ma'am, that's helpful. So I just want to understand, let's assume the 30 million inpatient and outpatient that visit our network in the pre-COVID world, pre-24/7 world. Do they also qualify as organic to get onto the platform?
Yes, they do qualify as organic.
Yes.
So it could be possible that when they visit the store, you would encourage them to download the app, right?
Yes.
Okay, perfect. That's helpful. There's a little question on about 60,000 rupees in tier 1 and metro. Is there a limit to how to grow? Because if you remember early
Sorry to interrupt you, Mr. Srinivasan. Sir, your audio is breaking, sir, from your line. Please check.
Should I repeat my question?
Yes, sir.
Yeah. ARPOB, it's been a big growth driver this quarter and maybe past several quarters. 60,000 rupees is what you said is the ARPOB in tier 1 cities. From an affordability standpoint, are we okay as a country in terms of the top 5-10% of the population? Do you think they can potentially continue to afford this? Because I was just looking at your own historical numbers. We were at 30,000 like 3 years back. So it's doubled. I don't think income levels have doubled like that. So just want to understand from an affordability standpoint, and it's not only you, right? I think it's an industry point as well. ARPOBs have gone up. May not be only related to price increases, but if you can help us understand what is the pricing environment like? Is there no competition at all? Everybody seems to be taking prices up. Will at some point of time the regulators raise their eyebrows and say, why are people raising prices or doing the ARPOB is going up? So just a philosophical question.
Yeah, I think two things are very important, two perspectives. One is that, our ARPOB has gone up because of focus on centers of excellence, high-end work like, transplants, TAVR, high-end cardiac work, minimally invasive. The second very important perspective is that if you think of the reason why Apollo started, it was to provide quality health care to almost every Indian. And if you look at our hospital configuration, it reflects the demographics of the city. So we have 1/3 general wards where the pricing is lower. We have about 20% premium rooms where the pricing is at a premium, and the average comes out to around 60,000 rupees. So that is the second perspective that you need to look at. The third perspective is the reduction in ALOS. And with this, so the ticket size remains the same. The only thing is that we reduce the ALOS and patients are there for a lesser period of time, and therefore the revenue intensity.
So, ALOS also is something that is a deliberate strategy. It's something that we continue to work on across our hospitals now. Be it robotic surgeries, minimally invasive surgeries, etc. There is a lot of medical advancements that we are seeing across. Even minimally invasive cardiac, CABG that we are doing now, a bypass in both Chennai and Bangalore, etc. That's going to go across. There are some multiple aspects. So, Dr. Hari, you want to add something on that?
Yeah, many procedures which the patient would occupy the hospital bed for a longer time have now been done with greater skill, and the number of days the patient stays in the hospital is come down significantly. Krishnan has talked about heart surgery. Now we are doing daycare knee replacement surgeries also. Normally a patient used to be there in the hospital for 7 to 10 days after replacement. But now we're doing plenty of daycare knee replacement. So the same intensity of surgery at the same cost with a lesser number of day hospital stay is actually a good factor which is adding to the ARPOB.
Got it, yeah. Thank you and all the best. Thank you.
Thank you. The next question is from the line of Shalin Kumar from UBS. Please go ahead.
Yeah, hi. Good afternoon, everyone, and thank you for the opportunity. So, one question on AHLL, right? The margin improvement have been pretty interesting over here. So, just trying to understand, when you look at unit economics level, what are the margins a clinic generally makes, and what could be the upside from the current margin?
Chandrasekhar?
Yes, ma'am. The H1 margin on the clinics is about now 15%. And it has a little tailwind of COVID, but on a steady state, it still is delivering around 9 to 10% at this point of time. So I believe that as we enhance our services and ensure continuum of care, this is the primary care clinics itself will start delivering anywhere between 12 to 14%.
Right. So, just to understand, let's say if there is a mature center where there is a reasonable footfall or occupancy, what is the margin at a clinic level? It's
17% is our mature number. The peak we have reached is 17%.
17%.
In fact, in some of the centers in Q2, we have reached that 17%.
Okay. So, high teens kind of a margin is possible at the clinic level, or maybe a bit more, right?
Yeah, somewhere that I think should be the range.
Understood. On our digital platform, while we have a very, very strong physical presence in terms of the pharmacies, what are the thought process in terms of doctor enrollment? Well, 6,000 medical professionals is a good number, but given we would like to go aggressive in this space, so how are we thinking of enrolling non-Apollo doctors over here? And similarly for like diagnostics as a facility, while we do have a presence, but still it may not match up to our digital customer base. So how are we thinking of working with digital these diagnostics, or are we thinking of rolling out the diagnostic franchisee centers at an accelerated pace?
Sanjeev?
Yeah, I think good question, and I think it talks about that. How are we going to increase our capacities towards the doctor side of it, as well as on the diagnostic services side of it. So let me just take the doctor side of it first. And yes, we've got 6,000 doctors in 138 specialties as of now listed on platform, and we are open for third-party doctors also to come onto the basically the non-Apollo doctors also to come onto the platform. And this is where we are now working towards two things. One is to enroll more doctors from non-Apollo side because those doctors are showing interest to get listed onto the platform. Plus, we would also get into our payroll doctors, so that continuum of care, where we say that at any point of time within 15 minutes you can get in touch with a doctor. That is possible, and so we will increase our capacities, with respect to the payroll doctors as well as doctors, non-Apollo doctors coming into our platform. So these are the two things that we are working on to increase 6,000 numbers to a 5-digit number, sooner. That is on this. And secondly, on the diagnostic side, Mr. Chandra mentioned about 500 phlebos being enrolled, and those phlebos are actually taking care of the 247 volumes as well as other volumes. So I think we'll continue to expand the capacities of phlebos as well as other infrastructure as required by territory. And in fact, we also have started moving into radiology. That is the service we have started last month. So I think on the diagnostic and radiology, as the demand picks up, we would actually increase our capacities also. So I think good point. Both the things are in mind, and there is a specific team which are working to strengthen and expand capacities on both the verticals.
Just to add, Sanjeev, since that's on diagnostics, we are doing this on a three-pronged basis. Where we are present and we want to saturate PIN codes in alignment with the digital requirements that we are driving, we are adding phlebo. So our phlebo count is now hovering closer to 900 plus in the cities of our choice. So our ability to saturate PIN codes is consistent, and we'll continue to work on that. Second, in terms of lab capacity, we have a combination that we are working on. One is asset-light, third-party lab management that we are going to do, besides some of our own that we will also add. So that will help us saturate markets where we are not available and where there is a digital consumer demand. The third is that we also have the benefit, which we have now begun, to be able to use the unused or slightly underused capacity utilization wherever possible within the Apollo large hospital network as well. So these are three-pronged to be able to leverage and enhance our capacity utilization and to be able to serve customers.
Sure.
And a lot of it will be done very cost effectively.
And any plan for inorganic growth in this segment, diagnostics, where you do not have a...
Opportunistically, yes. We are conscious of buying right value. And our targets are not going to be large. We will look at filling in some of our markets that we have earmarked for growth, where we have the right asset at the right price. Definitely, that is something that we are considering, but it is not a strategy of significant aggression. It will be a very well-calibrated strategy for opportunistic inorganic expansion.
Understood. That's it from my side. Thank you so much, and all the best.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. Chandra, just following up on the AHL bit. You've talked about the diagnostic business. So two things. One is, over a 3-year period, how do you visualize this business scaling up to, and where do you think we would be as a business in comparison to some of the larger listed peers in size and profitability?
So I think again a forward-looking point. So I'll just be little more directional to try and answer your question to the best extent possible. I think our growth rates will definitely be upward 25% CAGR, going faster than industry. That is a very clear message for that. With some investments and some opportunistic inorganic, this could be larger. And we are hoping to touch the 1,000 crore kind of a revenue mark in about a 3, if not a 4-year period, in at least a 3-year period. There could be acceleration to this plan based on how effectively we execute.
1,000 only for diagnostics.
That's right. I thought the question was only for diagnostics. Am I right?
And just following up, the other pieces in the AHL business. Have they started reaching a tip-off point in terms of you probably stepping up investments in them? The primary clinics, the daycare clinics. How are you seeing that piece of the business?
So I think we've provided a little view on that. On the clinics front, essentially we are growing and closer to communities, and we are setting up where we have large community bases that are available. So we continue to grow that. We have traditionally mastered and we have further improved our abilities to deal with the only format that we do this is in the clinics, the franchisee expansion. So that continues rapidly. But now with more integration into the larger ecosystem. So I see that continuously growing, and clinics will continue to grow and also create a clear pipeline of a continuum of care to all of our other Apollo ecosystem, the pharmacies, the hospitals, and some of the other AHL formats. On the cradles, we've reached a EBITDA perspective of about 14, and we believe that we could stretch that to about 18%. On the cradles, there is clear opportunity for us to. We are still at 60% in terms of utilization, so we would like to be about the 75 to 80%. On Spectra, we are looking at asset-light managed growth network, and our OT utilization, after a little lag, has now moved on beyond the 50% mark. But we believe that there is still some headroom there. But we're looking at an expansion of asset-light managed network in the Apollo Spectra, which is the format. The other format of opportunity, both as a need in the market, is for a clinical leadership in the space of fertility, which is extremely unorganized. While there are a couple of players who are organized, we still believe that there is a space which actually justifies Apollo's clinical leadership and the brand. And that is a space that we are closely watching, and we are looking at bringing in international standard protocols and to be able to look at unique engagement models by associating with top doctors and look at that as a growth opportunity. So in terms of sporadic growth, diagnostics, clinics continue bringing healthcare closer to communities, closer to large catchments, fertility in the fashion I mentioned, cradle opportunistically, but largely saturating probably our metro play and some sub-markets within metros. And Apollo Spectra largely going asset light and improve existing utilization.
Thank you.
Thank you. The next question is from the line of Ritesh Rathod from Nippon India Mutual Fund. Please go ahead.
Yeah. First, hi everyone. Need a clarification. 48% in online pharmacy, you have revenues coming from membership. When you point to that, you talk about your silver membership or platinum and gold, because silver membership is by default given free to everyone.
It's loyalty program as a whole, which has a combination of categories, and that accounts for it.
Okay.
Silver, gold, platinum, but it's a combination of all the three categories that gives us that business for us.
Okay. Second, we are now offering discount of blended level of 12.5%, what 12% you mentioned. Few quarters back we were not offering, and maybe once we get a funding partner in coming months, the discount will intensify. I presume that way. And when you see that this whole thing at the industry level, that people are not making gross profit at a unit level and the discount is being passed on, what would be the end game eventually for the online pharmacy? Where do you think things will settle down? Maybe your thoughts, your view on the industry would be helpful.
Over, sir, you again the answer?
No, I think Shobna may have answered this question already.
Yeah.
And we are at present, offering differential ratings of the circle members, not in general, but going forward we will see what we can do based on the market conditions.
But right now we're at 4% of internal.
Yeah. I think that was answered earlier.
Okay. Maybe third one, on the RPOP side, given for the hospitals, given the cost inflation which would be there and cost normalization, both will happen on the clinical side as well as on the expenses side. Would you be willing to take a price hike on a like-to-like basis in your hospital treatments? Is that a possibility? Like we have seen even on the pharma generic products on the regulated NLEM side, government has allowed exceptional cases where they have taken price hike because of the cost inflation. So is there a possibility in next 6 to 12 months?
Yes, that's what we do. We pass on the price. The inflation cost are reflected in the prices.
And what would be that price hike on an annual basis?
Looking at 3 to 4%.
At a blended level,
Yes.
Okay. Thank you. That's been nice.
Thank you. Ladies and gentlemen, we will take the last question from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, thanks. So just 2-3 questions of pharmacy segment. One, just a clarity. You mentioned 4 to 5 active users per day. Is that including the offline pharmacy network as well, or are you talking only online?
That was only for the online. We talked about 4 lakh active users every day. So that is only online.
Okay. Just trying to understand. If you look at the transactions that we're doing, I don't think we are transacting more than 12 to 15,000 orders total on all 3 services. So there's 4 to 5 lakhs users coming and total transactions are only, let's say, less than 15,000. How do you explain that?
No, I think, there could be many factors to it. As we said that, we are building up our entire capacities. We are opening up more and more PIN codes. We are stocking up. There are bits of pieces going on the technology side. So I think from the, and there are always users, who try to find out certain things. They just come over to experience. I think it's a matter of another 60 days to 90 days. We'll have a even better throughput, with respect to the transactions being, orders being given versus the, active users. I think at this stage it is more of capacity building, trying to get the right traction, trying to get the right set of users. And as I told you, and ma'am also told that, there are many users who are, we don't give, we don't want to play on to the discount route. And that could be one of the reasons that, why people do not give as many orders, although their, activity on the platform is pretty high.
Okay, I'm just a little surprised that 95% users are coming to the platform and not transacting. That number seems very high from my experience of tracking any app. So that's the number I mentioned that.
That's okay. It's a good question. And I think it's a matter of 1 or 2 more quarters. You would see a better traction, better throughput from the active users versus the transactions on the platform for any given day.
Sure. And second question was on how do you plan to converge the discount between offline and online? So offline, you're giving 10% discount right now. Online, your discount varies from 15%, 20%. If I'm Circle member, if I'm giving bill of more than 1,500, I get more than 20% discount. So what will be the eventual gain? Would offline continue to be 10% and large part of those users shift to online and that will cannibalize large part of the revenues? How would the two segments be different in the future?
In the offline, we continue to be 10% for the walk-in customers. For the circle customers and live customers, we have some plans which we recently introduced that may move up, but blended discount we have some around 12%. That's the plan.
But why won't a user simply go into app and get a higher discount? Why would you satisfy 11-12% only on the offline network?
They are based on the value customers. We are offering a differential percentage. That I don't think you would have that communication. Recently, we introduced even circle membership. Scheme for the offline customers, which you will see going forward how it works.
Sure. And just last question for Krishnan. The receivables went up by almost 550 crore in first half. Is there a pocket of segment? Is it simply because you talked about insurance percentage have gone up significantly that such a large increase in receivables has happened?
So that's not because of healthcare services. Primarily, there is this receivables coming. There's some shift. So earlier, if you look at the back end, all the inventory was held at the AHEL level. Now, if you look at it, the inventory moves into APL, but there is a receivables from the Apollo Pharmacies Limited, which is the front-end pharmacy. So this is the reason for the increase. So this will actually come down a bit by 100 crores, but it will remain at these levels as we go forward. Once this gets shifted to Apollo HealthCo, you will not see this in our books.
So you want out of the total receivables, how much will be this pharmacy receivables that you're talking about outstanding?
700 crores.
700 crores is from pharmacy.
That is correct, and that is represented by the stock in the front end, the pharmacy stores as well.
Okay, sure. Thank you, guys.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you all for spending time on a Saturday afternoon. As you can see, Apollo has been, not only have we been resilient, but I think we've been very agile in our ability to adapt to new technology, to circumstances in the environment around us. I can assure you of this at this time that we will continue to focus on improvement in clinical excellence, clinical outcomes, and thereby look at increased volumes and therefore better revenues in EBITDA. Thank you all for joining us.
Thank you. Ladies and gentlemen, on behalf of Apollo Hospitals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.